Well, hello again. Today we're going to talk about depreciation and capital expenditures and how we deal with that during the budgeting process. Well, there's two ways that we spoke about creating a budget. The one was obviously through the add a period function, and the second way is to import your income statement and then build your balance sheet around that imported income statement. And we have a separate video that talks about that. This section is only going to deal with how we add a period and how that treats depreciation and the related cash items inside our budget. So what we do is, as always, we add a period, and I'm going to do, I'll just do a 12-month budget. As always, we click budget and we click our wizard element. Now, when we do this, this allows us to actually create our capital expenditure at the bottom of our assumption space as such, and we then put in our various budgeted parameters, which I'm going to do relatively quickly, just make some couple of assumptions, and for each of the individual line items, 13%, fixed costs, I don't know, let's call it $450,000. And here we put in what we estimate our depreciation will be based on our existing fixed asset environment as well as the new capital expenditure. And we can calculate that, and whatever the way we want to do that, it's irrelevant. All we need here is the number. So let's say, for example, the additional depreciation is about $5,000. So I'm going to make that $70,000, right? And I'll keep our average cost of debt at 8%, tax at 30%, receivable days at 50 days, 110 days, and let's call it 70 days. And the capital expenditure, let's call it, was $50,000, right, for some new technology or whatever the case may be. All right, so now what we've done is we have increased our depreciation because of our additional capital expenditure, and we can calculate that based on our normal amortization schedule, whatever the case may be. And we've also added $50,000. Now, from a cash perspective, whether we're leasing this or whether we're purchasing this with cash, this is going to show as a capital acquisition of $50,000 in our cash flow. Let's see how that happens. We press our update. There is our budgeted income statement, budgeted balance sheet. And if we just go to our reports, let's have a quick look at our reports. And what I'm going to do is I'm going to focus on, first of all, the cash flow statement, and I'll press OK. And in our cash flow statement, let me just make that a little bit larger so that we can see what we're doing here. In our cash flow statement, you should notice that we have a capital expenditure budget of $50,000. So there is the cash component. In other words, that is the component of cash that we're going to use for our fixed assets. And as you can see, the system automatically deals with depreciation, it deals with everything else, and it just shows the actual capital acquisition element when we use the add a period budget function. And you can also identify exactly how that is being calculated. If you go through your various reports here, it will show you the item of how the capital element has been dealt with. Let me just find it for you here. Right, so there you notice cash due to investment in non-current assets, and previously our depreciation was $65,000. The budgeted period is $70,000. So that gives us at least the way that our depreciation works, and that is our capital expenditure item showing us the cash component that relates to our fixed assets. Okay, so there it is, all calculated for us, and it's also clearly shown in our cash flow statement. All right, and the related cash flow here shows that we are achieving $238,000 worth of cash inflow for that budgeted period. And then automatically what the system does is it says, okay, that cash was deployed against debt reduction. If we do not wish that cash to go against debt reduction, we have to make a manual adjustment to cater for that. So let's have a quick look and see how we do that. I will exit out of our reporting and go into our one-page scorecard. And for example, what we would like to do is we'd like to see the majority of this cash flow actually going to cash at bank without the repayment in our short-term debt. Or on the other hand, we want to take $100,000 of this and repay our long-term debt and put in, let's call it another $150,000 into our cash at the bank. So simply all we do there, let's call it was additional $150,000. So I'm going to make that $158,000. And I'm going to reduce this to, let's call it, we said $100,000 repayment, so I'm going to make this $700,000, right? Okay, so as you can see, this will now re-establish what our short-term debt should be at the end of this period, based on the fact that we've taken some of this cash and we put it at cash at bank, and we've actually repaid a portion of our long-term debt. Now, remember, we've made an adjustment to our budget, and we then press our update so that it automatically saves that into our data loading capability. And we can also see that now our long-term debt is $700,000 and our cash at bank is $158,000. So we've already done that. And if we go back to our reports, view and print reports, and quickly go and have a look at our cash budget as such, we can see how that now has changed to cater for our different circumstances. Once again, the cash flow hasn't changed. The amount of cash that we've generated for the given budgeted period hasn't changed. However, what has changed is the way that we've used that surplus cash. So what we've done is we have actually reduced net debt by $81,000. So a portion of that was $100,000 worth of long-term debt, and a portion of that was some short-term debt increase, right? Okay, and there is the $150,000 that we've put into our cash at bank. So that's how our cash has been deployed based on our current thinking for our budget period. So hopefully that was helpful, and we will also consider how we deal with depreciation when we import an income statement as well. So that'll be in a separate video. Bye for now. All the best.